Our speaker for session one is Bill Lapp, Principal of Advanced Economic Solutions. Bill graduated from Southern Illinois University in 1979 with a BA in Mathematics and from Purdue University in 1981 with an MS in Agricultural Economics. Bill has over 25 years' experience in analysing and forecasting economic conditions and commodity markets, and has a wealth of experience in providing comprehensive economic analysis of these commodity markets. Prior to forming Advanced Economic Solutions, Bill was Chief Economist for Conagra Foods, and he served on numerous boards. Advanced Economic Solutions is dedicated to providing high-quality economic and commodity analysis to agribusinesses and food companies. Formed in 2005, Advanced Economic Solutions provides forecasts and analysis for procurement, investment and risk management decisions in order to help these companies in their decision-making process and strategic thinking. Bill's presentation today is on dynamics in world grain and oilseed markets for the coming year. Bill.
Good morning, and thank you for the opportunity to address this timely subject. That we've had great dynamics in the markets here recently, and I started putting together my presentation about a month ago, and I had to make several iterations of the presentation, and so finally it's come together, and here we are at a different point than we were 30 days ago, and probably will be at a different point 30 days from now hence. A couple things. I'm going to keep my comments short enough so that there'll be time to address some of your questions that you might have for me, and I'd enjoy hearing those. If any of you have questions after the presentation and want to approach me, I'd be glad to talk to you at that point as well. Secondly, I certainly want to thank you for allowing an American to come in here, given the turmoil that our country has caused in the trade world in recent months, and I personally apologize for some of the angst that it's caused everybody in this room. So, and I'm going to talk a little bit about trade today at the end of my remarks, and then I'll be on a panel this afternoon as well to discuss that again. So you'll have a couple shots to hear what I have to say or question what's going on in terms of the U.S. trade policy. So with that, I'll begin my remarks. First, I want to mention that world economic GDP is favorable. We're running at a favorable rate. You can see some of the economies that are accelerating and some that are slowing. China is not the country it once was in terms of growing closer to 10%, but is still growing at a rapid clip. The U.S. economy, which I think is important, is one of the leading economies, and we're starting to see interest rates increase in the U.S. in response to this. So the risk for this trade outlook, from this GDP outlook, is in what happens with regard to trade, and we haven't reached a point where trade is dramatically impacting global growth in GDP, but it certainly could, and we have historical precedents for that many years ago. I think one thing to note is that U.S. interest rates on the increase probably means the U.S. dollar is destined to increase in value relative to the broad basket of developed economy currencies, but also relative to the Australian dollar. And I think that my prediction would be that at some point we're going to see a 70-cent Aussie dollar sometime in the next 6 to 12 months. It's also worth noting what's happening in the dynamics in China and the valuation of the yuan, and part of how China is battling some of the economic slowdown that they're facing, and the depreciation of their currency is very important, and very important to watch these in terms of how it changes trade flows, how it changes the value of these commodities, and the dynamics thereof. So just to look at some of the different currencies, and you can see it's pretty consistent what's happened since February in terms of the change in the value of the dollar. I think interest rates in the U.S., our Federal Reserve is poised to increase interest rates 1 or 2 more times this year. I don't think there's a meeting this week. I don't think they will this week, but there will be 2 more chances, I believe, this year for the Federal Reserve to raise interest rates. And given the strength of GDP and the indicators of higher inflation coming, I think we will see further interest rate hikes in the U.S. In the coming year, or in the coming 6 months. Okay, so what's happening in demand? One thing I want to note is that oilseeds are really the leader in terms of global growth and demand. We're seeing strength in corn as well. I think a lot of that has to do with the ethanol policy, which is reaching a maturing. So that growth rate may not be sustainable, but it does seem that the oilseed growth demand is sustainable. We're having a hiccup this year. Chinese imports are forecast to actually decline year over year, which is the first time that's happened in over a decade. But oilseed demand for protein meal and for oilseeds continues to grow. Energy is an important facet in terms of forecasting what's going to happen in the grains. It's tremendous, the growth in global demand for crude oil that we've seen pretty much unabated over the past 2 decades, continued growth, and it's very strong right now, and that's supporting what's going on in crude oil markets. It's important, I think, to note where the contributions to this growth have come, and it's primarily in developing economies, and most notably in China. Chinese demand for energy continues to increase. It's the focal point, more than the U.S. being the focal point for price discovery and energy. And that's going to only continue in the coming years. Developing economies have seen fairly flat growth over the past decade. Crude oil production, however, is increasing in the U.S. The fracking, the shale play in the U.S. is leading to a greater growth in oil output in the U.S. and Canada. And we're seeing the U.S. become pretty much no more of a net importer, and the trade balance has changed dramatically there, and the dynamics have changed. So the thing to note to me is the bottom line there is that we're seeing NYMEX crude oil somewhere near $70, Brent near $77, and the cost of production, the break even, is below $50 per barrel. So as they say in the States, it's a good time to be the governor of Texas when you've got high crude oil production and a low cost of production. And there you see what's happened with crude oil production. We were at $43 a little more than a year ago, 14 months ago. We've seen that the market move up towards the $70 mark and beyond. We are seeing some supply disruptions. The break in Iran with the deal we had with them to allow them to export. Libya, Canada's had some production. So there are reasons to believe that we can sustain this price for some time, but the upside probably is limited because we continue to see that expansion in supplies around the world. Okay, so I've talked enough about subject other than grain. I guess it's time to actually get down to the nuts and bolts of the presentation. So what are the key influences on the market been thus far in 2018? And I've got a laundry list of them there. First was the winter wheat drought that we had in the southern plains of the U.S., which dramatically reduced their output in Texas, Oklahoma, and Kansas. We followed that with the Argentine drought, which was key in driving up soybean prices and changing the dynamics in the oilseed markets. More recently, we've seen a smaller European and Black Sea wheat crops, grain crops, and this is really in the past 2 to 3 weeks that we've seen this really influence the market. Kansas City futures and Chicago futures are both up roughly $1 per bushel in the past month, a dramatic increase in prices of roughly 25%. So we've seen the tightening of supplies globally from Europe, European Union, the former Soviet Union, Russia, Kazakhstan, and Ukraine influence the market pretty dramatically. We're seeing expanding drought in Australia. Prospects there are decreasing in terms of grain crops here. And all these have led support to the prices and probably means that the lows have been made, that we have some upside risk from here, but I will say that as long as the U.S. has larger supplies available, it's going to limit the upside potential for U.S. futures. I think overall we can say that world supply demand is tighter, and that's a prospect for corn, for barley, for wheat that's going to support the market. It contrasts with the oilseed situation, which is not as tight. The spec funds, the managed money funds, the people who are really the gamblers in the market, if you will, have dramatically changed their position here recently and probably are going to do it again, and I'll talk a little bit more about that in a second. In terms of U.S. crop prospects for our major crops, corn is off to a great start. Soybeans are off to a great start. We're nearing the latter stages of the production. We'll get our first estimate of those crops on August 10th from the U.S. Department of Agriculture, and we expect those to be near record yields for both corn and soybeans. And spring wheat production, notwithstanding a recent tour that said prospects there are not quite as positive as they thought, we're looking on somewhere in the order of a 40 to 50% increase in spring wheat production out of the northern plains of the U.S. and larger production out of Canada this year. So more plentiful supplies, and that influences our Minneapolis wheat futures more than anything. And the final thing is the U.S. prompting of a trade war, and I'm going to talk more about that at the end of my presentation, and certainly, as I mentioned, I have another session later today, and we'll answer any questions you have on that, but I think that's had a dampening effect on the corn, wheat, and soybean markets, not only in the U.S., but globally. We're going to see here shortly, I think, whether there's a gumption to continue fighting this war, or whether both sides will back away, most importantly the U.S. So a couple ideas here. The speculators, the futures speculators, the U.S. Has an agency called the Commodity Futures Trading Commission. They report everybody's position in cumulative, summed up each Monday. So we get an idea of where these funds are. And the spec funds are the guys that are what we say, got a hunch, bet a bunch. And you can see here where they've gone over time from short to long, above and below the zero mark each year. And it's hard to predict what the catalyst is going to be for them to change from a short position to a long position. But I just want to say that when they have significant short positions on, that's when end users should jump in and take advantage of the market. And when they have significantly long positions, that's probably a time for producers to try and take advantage of these markets. So what we've seen here more recently is in early calendar 2018, significant short positions on for these funds. The catalyst there was a drought in the southern plains of the U.S., as well as Argentine drought, which impacted soybean supplies globally, and they moved from a significant short position to a significant long position. As we entered into the trade war and the trade dispute around the world, and the U.S. Put tariffs on steel and aluminum, and China responded by putting tariffs on soybeans, we saw the funds get significant short positions. I think this is a dynamic that's going to change. I think it's going to change significantly in the next couple months, probably not because of a change in the prospects for a trade war, but more likely because of prospects for the European crop, the Black Sea crop, and the Australian crop are diminishing on the order of 5 to 10, maybe 15 million tons in a matter of 30 days. And I think these funds are going to switch over to long positions. And that's already in the market to some degree and probably going to continue to be a price supportive factor. These charts just show on the bottom axis, they're a little hard to read. One is for corn, one's for soybean, and one's for spring wheat. So the bottom axis just tells you what percent the U.S. Department of Agriculture is rating the crop good or very good. When they rate it very good or very good, you tend to have higher yields, which is on the y-axis. And for corn, soybeans, and North Dakota wheat, spring wheat, they're all rated among the highest we've had in the past 20 years. So we've had, after a drought in the southern plains in the U.S., we've had very favorable weather for our row crops and for spring wheat in the northern plains. And this extends on into Canada. who's having not as good, but a favorable growing season as well. So there's more plentiful supplies of wheat out of North America this year, more plentiful supplies of corn than we had thought earlier. So does that mean that the market has limited upside? I don't think so. There's a couple things on the coarse grains, on the corn, barley, milo side. You can see two lines there on this chart. The blue line is the stocks as a percent of usage at the end of the marketing year, with 2018-19 on the far right forecast. And so that'll be next summer, the middle of 2019. The stocks are forecast to decline to one of the lowest levels we've seen in the past decade. And when you exclude China, it's not quite as draconian, and I think that's the way to do it. I don't think we have a good handle on Chinese stocks of grains or oilseeds. It's technically a state secret in China. So one way to do the analysis is to do it completely in whole and take the numbers the USDA provides you. And another way is to exclude China from that calculation. I think that's more accurate of market conditions. And I think that's telling us a lot there that we have tighter stocks. So the outlook for corn futures essentially, and probably for the barley market as well, is fairly positive from this perspective. And you've seen European feed values go up, and there's probably some support for the wheat markets in Europe as well as a result of that. But stocks are declining. I think the decline we're seeing this year is one that probably promotes us to see corn futures closer to $4, which should be the highest since 2014. And you can see in the US, I've got the stocks use ratio there. The biggest factor that I watch, I think that market participants in general watch, is what is the US corn yield going to be? And corn goes through a pollination process, and it's a fairly short window, and it's hard to predict what is going to lie ahead, whether you're going to have hot and dry weather or favorable weather. But it's a big crop. It's 14 billion bushels. It's the biggest crop. We produce more corn in the U.S. than we produce of all other crops combined. So corn is truly the king crop, and so we watch very closely what yield prospects are. We'll have our first estimate from the U.S. Department of Agriculture of the crop, as I mentioned before, on August 10th, and we'll see what kind of yields we have. I'll just note on that yield chart on the right-hand side, 2012, we had 123 bushel per acre corn yield. Corn futures were over $8 for a short period of time as a result of that. Today, they're half that value as we're having much higher yields in recent years. I would also mention that in 2017, yields far exceeded expectations, whether it was cool nights for growing late in the growing season or adequate subsoil moisture. There's a lot of excuses, but one thing that's certain is the genetics have made corn yields in the U.S. more stable and accelerated those yields as well to higher levels. So we'll see on August 10th. The prospects so far are very favorable. I'm forecasting yield of 176 bushels per acre. So on August 10th, that'll be your first chance to see how accurate this economist's forecasts actually are when the USDA comes out with their forecast. Very important metric that changes the market dynamics. So what is the outlook for corn futures? I think we'll see our low in the U.S. market by September 1st. I think if there is downside to the market, it will have passed by then. I think we're going to envision that this will be the lowest price we'll see for corn in several years. Higher corn prices certainly support higher wheat prices globally. 2018 forecast is for $3.75. We're a little above that today. And then 2019, $3.80 to $4.20. We still expect bigger production out of the Ukraine and bigger production out of Brazil in the coming year. Demand globally is good, but we will have larger supplies for those countries. So that'll probably limit the upside. Okay, so moving on past corn, what about wheat? And this is where the inclusion or exclusion of Chinese stocks makes a big, big difference. If you look at that blue line, which is total world stocks, you get a much different picture by including China than you do when you exclude China. And I think there's different ways to calculate how tight supplies are, and I think the red line is the first step towards indicating how tight the global supplies are. And with world production set to decrease significantly on a year-over-year basis, we're going to see tighter stocks. I think that at a stocks-use ratio indicated there of 20%, we actually could be 1 or 2% lower than that. So there is a more bullish story. The U.S. has more plentiful stocks, but the world is tighter, and eventually the world will have to come to the U.S. For wheat, and at that point, I think that's when the futures in the U.S. will start to increase. I will note also that we continue to see an increase in exports out of the Black Sea region, Russia, Kazakhstan, Ukraine. Those are all have increased dramatically in terms of their world share over the past 10 years. It's gone from 11% to 32% of world trade. World trade has expanded, and during that time, the U.S. has been the greatest loser in that battle, and we've devoted more of our acres in the U.S. To corn and soybeans. So it's no wonder that we've seen that lose. But world trade has expanded, and the former Soviet Union countries, most notably Russia, Kazakhstan, and the Ukraine, have expanded to fill that in dramatically and taken advantage of that. Now that's a hard wheat, more hard red wheat, so there's differentiations between the crops that I'll mention here in a second. So, major wheat exporter production, we want to look at those different countries and where that's going. We're seeing a decline in the prospects for the EU 28. We're seeing a decline in the FSU prospects, probably a decline in Australia unless we get some rain in the very, very near future. We could see 20 million tons or lower from all the discussions I've had with participants at this meeting. So there's a lot of concern here about what's going to transpire. So what does all that mean? I think there's another iteration you have to take here, and I'll do it real quickly. And what I like to look at is the global exportable supply of wheat. So I take the production from those countries indicated on the previous, the major exporters. I add in their beginning inventory. I subtract the domestic demand in each of those countries, and that leaves me how much of a surplus we have relative to world import demand. So the calculation and the math behind that is a lot of iterations and subject to some error, but what it tells me is that we have a much tighter situation in 2018-19 than we've had in previous years, with only 16 million tons of surplus. So that means that if you get much tighter, you're going to be drawing into inventories to a greater extent. You're probably going to draw on the U.S., which hasn't been a great participant in world export markets in recent years, and that's very supportive to prices. I think what's happened in the Matif market, the European market, tells you really all you need to know in terms of the strength in the market. You can look at the U.S. futures, but also the European futures to a greater extent have shown the kind of bullishness we've got. The U.S., export sales in the U.S., you look at that, the far right, we continue to be well off year ago, the lowest total in 9 years. So the market has not come to the U.S. For wheat. And when it does, that will be the chance for futures to move significantly above $6. I don't know if that will happen. The market may be met more easily by inventories from the former Soviet Union, from the Black Sea region, rather than pulling U.S. inventories. But so far, this has been a limiting factor on the price strength in wheat, is the lack of export sales out of the U.S. As I mentioned, spring wheat supplies are up dramatically. So we're going to have, this is a factor that influences the Minneapolis market. We had Minneapolis wheat futures a year ago that were dramatically above all other markets. The availability of high quality, high protein wheat supported that market. So while other markets were relatively weak, you saw the basis in the Kansas City market and the Minneapolis futures very, very strong. So what's the outlook? Kansas City futures, which is the proxy I think is more relevant. I know Chicago is traded more frequently and has greater liquidity, but I think Kansas City reflects what's happening in the U.S. market more appropriately. We've already begun an uptrend. We're going to have higher prices in 2018 than we've had. In 2019, we'll see prices $5.50 to $6, which in and of itself would be the highest price since 2014. If we continue to see reductions in the European crop, in the Russian crop, and the Australian crop, I think going above $6 is certainly plausible, and I would, if we saw those crops diminished by say 5 to 8 million tons, to call an average price for 2019 between 6 and 650 would be a reasonable target. I will say one thing about the U.S. has 5 classes of wheat we produce, and in the Pacific Northwest, Washington State and Oregon is where we produce most of our white wheat. And white wheat is the class that's tightest in supply. We've seen strong export demand. We continue to see strong export demand, and I think that may have a greater influence on Australian values than our overall futures in Chicago or Kansas City do. That we have a cash market for specific wheat that is of the same variety for the most part as you see coming out of Australia, and it's the tightest one we have in supply. So I think that, aside from production problems, we have stronger price outlook. We have even greater price strength potential for the white wheat and a weakening Australian dollar. So there's things to be very optimistic about in terms of prospects for those who have a crop to sell. So let's go to oilseeds. It's a different world, and I'll close up my remarks and open them up for questions. China's been on a tear in terms of imports. They import about 60% of world soybeans. Their dominant country they import from is Brazil, and second would be the U.S. heretofore. Because of the tariff imposed on U.S. soybeans by China, expectations are their imports will decrease. There's some ways around that import tariff that China may employ, buying into state reserve and then refunding those importers for the tariff has been talked about, which would be positive for demand. But this, I think, instead of being 103 million tons, you're at 95 million tons. So you've lost 8 million tons of demand by the estimates of the USDA in one fell swoop. And that's a significant loss for global demand and changes the balance quite a bit. So you can be more positive about feed grains, more positive about wheat, and less so, I think, about the oilseed market. U.S. soybean stocks continue to rise. My expectation is we're going to have 671 million bushels of soybeans at the end of the 2018-19, that should say 2018-19 in the lower right crop year. So we're going to be carrying a big supply of soybeans unless there's a dramatic change in prospects for trade. Soybean futures upside is limited, and you can see there I have a less robust price outlook for soybeans, and our supplies may weigh on that price to keep it below $9 for some time. Okay, couple questions, and then I'll get into talk a little bit about trade policy in the U.S. to the extent I have time. But Chinese inventories are going to do they dampen? It's hard to say. Do they really have these inventories? This is a really important question. I don't believe they have such a great share of world wheat inventories. I just don't think they exist. I think that there may be some overstatement. There's no way to prove this, but you have to wonder, does China have the supply and the inventory to survive without imports for a significant part of their time? And China is very sensitive to food security issues, so some of this may be true, some of it may be on farms, but this isn't going to be an ongoing question. And I don't think this is really I'll just say this, Can they dampen the price outlook? Possibly, but I don't think that we should see a massive liquidation of their stock should we see a 10, 20, 30% increase in prices. I think whatever inventories they have, they're probably going to continue to hold on to. Okay, so let's talk about trade. Make Brazil great again. What a policy we've endeavored on in our White House here. If you look at that chart on the lower left, you'll see two lines. Kind of a reddish line is the value of soybeans at Brazilian ports, which over that period of time, which is roughly a year, has been fairly flat. And then you can see what's happened to the U.S. price. And we've gone to a significant discount of $60 to $70 US dollars per ton to the Brazilian farmer. So U.S. is supplying soybeans to other countries such as Europe, which our White House administration has viewed as a great victory that because we beat ourselves up so bad with China that we actually are supplying more soybeans to Europe when it's actually just economic sense. And this is probably going to continue, and there's some short-term ramifications for this and some long-term ramifications. But during the month of June, as it says there on the right, the U.S. farmer is revenue opportunity, his income, has diminished on an annual basis by $88,000 by my estimation for a typical farmer. So, you know, to say there's winners and losers in a trade war, I guess is true, but I think the biggest loser has been those in the Midwest who helped elect the current administration. So there's a lot of curiosity in my brain about why we're endeavoring on such a policy and what the end game actually is. You might get a flavor from just listening to me that I'm not a big fan of the tariff situation we have. So if I'm not making that clear, I will hear. So, you know, when you have a trade war going on and the stock market's going great and the economy's going great and you've only got one small wart to take care of, well, you throw a little money at it, and that's the U.S. farmer. And so we, the taxpayers of the U.S., are going to throw $12 billion at farmers. It's going to come in three different ways. There's going to be direct payments to farmers, which I don't think influence the market a great deal. There might be purchases by the USDA, direct purchases, and that would be something that would be supportive to prices. And then there's a little more, it's nefarious, but it's a little masked what's going to happen in terms of how we're going to open up export markets that heretofore we haven't got. So on one hand, we're closing up export markets, and on the other hand, USDA says we're going to spend some taxpayer money to open those up. So it's a real study in contradictory logic. Somebody asked me yesterday, what does the U.S. farmer think of our trade policies and what's going on? And I said, quite frankly, they're getting more and more angry every day. So watch the first Tuesday in November when we have our election, and we have 435 congressmen and 33 out of our 100 senators up for election. That will be a good litmus test to see how well we're doing in terms of public opinion and the trade war. Okay, a few thoughts. I'll run through these quickly, and then we can get on to the questions, where we might be headed. And these are just one person's thought. I think, and just my scenario. I think there's limited incentive for either side to back down. I know that China and the U.S. said they have an agreement to talk about maybe talking, and I don't know how far that will go. There was talk that we resolve the nuclear crisis in North Korea too, and that's proved to be not a actual fact. Escalation of the trade wars is very possible, and that's problematic. Trade flows are obviously already changing, especially in the oilseed market. We export about 25% of our pork and have our three major countries that we're supplying, put tariffs on our pork, so it's changed the dynamic in our pork market. The longer term and new trade alliances, and that was discussed earlier today by the minister, the TPP-11, there seems like there's being more trade relations being formed over and over. U.S. reliable as a trade partner is being diminished. NAFTA, I think we're just going to continue NAFTA as it is. There's not going to be a big change. I don't think we'll reach an agreement. If it is, it'll be NAFTA in small changes. And if our economy in the U.S. goes into recession, which it's not poised to, and I don't probably think there would be until at least 2020, we could see an escalation of the trade wars and more tariffs to protect in the guise of trying to protect U.S. industries. So these are not very positive things to end on. So I hope somebody will have a question that'll provide some shining light and something positive I can say about what's going on. But I think that the trade war will not end in calendar 18. I don't think the tariffs will be lifted. I think this extends at least into 2019. So, Stephen, with that, would be glad to answer some easy
Bill,
questions.
thank you. The challenge has been thrown out there. Anything positive questions, any comments? Please take this opportunity. I'm not sure if this is positive or not. What are your predictions in the US elections in November?
We have 33 senators up. Our Senate is really balanced. It's about 51 Republican and 49 Democratic. Of the 33 up, a majority are Democrats. So in the Senate, we probably will maintain a Republican majority. The House is a big question mark. We're not sure where that's going to be go. I would say there's only a slight chance, but a slight probability greater that the Democrats will recapture the House of Representatives. And then it'll be I guess a split government. We'll have a Democratic House, a Republican Senate, and a Republican president. So.
Okay.
Bill, Pat O'Shaughnessy from GTA. There's a country called Canada above the United States. How do you think the NAFTA agreements and all the trade policy arguments or whatever that the Trump administration are putting out, how will that impact the flow of Canadian grain? Obviously, it seems to me a lot of grain that would have gone into the United States has got to go somewhere else.
So thus far, the flow of grain into the U.S. from Canada has not been impeded, and it is an important part. It's of all the durum wheat we mill, half of it comes from Canada, and there's a significant amount of oats and spring wheat that comes from Canada. I don't think that will be impeded. I think that Trudeau is up for election in October of 2019, so he's going to be there's one factor that says don't sign a new NAFTA, and that's that he is being asked to have a stiff spine and stand up to the U.S. And there are a lot of industries in the U.S. where there's a lot of desire to maintain status quo on NAFTA. So I think it'll be a lot of angry talk back and forth, for lack of a better word, to be kind and mixed audience, between both sides. I just don't think we're going to get very far. But I think the flow of grain from Canada into the U.S. Probably continues unabated.
Okay. Well, let's try something positive. There's been a lot of sorry.
Hi, Bill. Quick question on the domestic demand in the U.S., especially for corn, as you said, that it has the potential to bring up prices for the wheat complex and the others. I was wondering about the ethanol demands, or specifically the mandate, right? So now it's E10. What is the probability of that rising to E15 in the U.S.?
Yeah, so ethanol usage in the U.S. for corn, takes up 30 million acres. It represents 40% of demand for corn, so it's a huge, huge factor. But it's also an industry that's completely matured. Our rules have not changed. There's a limit of 10% of ethanol that can go into a blend of a gasoline. So that hasn't changed, and we're not expanding our auto fleet or consumption of gasoline significantly. So I don't think there's any strong impetus to reduce that demand by changing the laws, but I don't think there's going to be an expansion. So there's a lot of talk about it, but it's really a market factor that's not going to change to a great deal. There's some inside baseball, as we say, in terms of the rules, but I think demand is going to be fairly flat for ethanol, and we won't see any strong impetus by Congress to resolve that or change the policy.
Okay, thanks.
Yeah, g'day. You had a chart up there showing the percent of world wheat stocks sitting in China, and you said it was lower than what the market had expected. I think USDA has it more like 51% of world wheat stocks. What have you based that data on? Because I think it's quite significant, particularly for the Australian market, if we grow a crop.
Yeah, if I understood you said the stocks used for wheat. You were talking about, okay. Yeah, the reason, if I got your question right, the reason I think it's going to be lower is that I think that was based on July 10th USDA estimates for European wheat, Soviet Union wheat, and Australian wheat. And I think all those three face downward revisions in the next month. So I think we're going to look at a tighter supply. I think the U.S. spring wheat crop from last month's estimate also comes down. So I think that will show up right away on August 10th. And it's the reality that we seem to be trading today in these markets is that whatever we thought 2, 3, 4 weeks ago, it's a smaller global supply, and it's shrunk in very, very short order. It's a good question.
Bill, I think we have time for at least one more call. And if you could introduce yourself before the question, please.
Ross Kingwell from the Australian Export Grains Innovation Centre. Can you just talk a little bit about US infrastructure with respect to its supply chains, the quality of it, the investment in it, and how farmers are being affected by that?
Yes, so our infrastructure. So we have the fortune of a river system that runs roughly 1,000 miles right through the heart of the grain belt. The lock and dam system there is in need of repair. It's not on the verge of collapse, as I've heard some suggest, but it is. There is a loss of put through on that system because of the system. The Pacific Northwest, which is primarily a rail destination market, is fairly flush and has a great deal of capacity. I think there are limits to how much grain can be exported out of the U.S., corn and wheat and soybeans. But we have excess capacity right now. I don't think it's going to be a constraint that's going to limit how much the U.S. Can move in terms of grain in the next year.
We'll do one more question, and then Bill's back on later this afternoon, so
yeah.
Please save other questions for later on. So one more, thanks.
Thanks, Bill. The issue of sorghum out of the US is my interest point, given that we've had the on-again, off-again tariffs and duties on US sorghum from China, but then they've also had the uptake of extra sorghum into the ethanol system in the US. Can you comment about supply availability as a result of these moving factors?
Sure. So sorghum, grain sorghum, milo. So when the U.S. Naively thinks they should put tariffs on things, they just get a block in steel or aluminum and hit hard and hit big and hit heavy and not much of a surgical strike. When China decided to put tariffs on something, they said, we're going to have a laser focus on what we put tariffs on, Kansas, the state of Kansas, which is important to agriculture. It's got important congressmen in terms of agricultural legislation, grows most of the sorghum. So China put those tariffs on our sorghum. So we stopped shipping, and then they took the tariffs off, and then the ships started sailing into the sea, if you've ever seen the maps, and then the tariffs were back on, and then they started shipping from to a different port all the way back to Spain, and then the tariffs were back off again. So I think that's going to continue to be a crop that's kind of used as a test case by China to penalize the U.S. In the future. I think that it's going to, the reliability of the U.S. as an exporter is going to go down in that. I mean, the U.S. will not want to produce as much grain sorghum. It's already seen a reduction in how much it produces over the years. Our genetics for producing corn allow you to have yields that are similar to that. So I think the prospects there are highly questionable for grain sorghum. I don't know what the outlook will be for tariffs, but I think you're prone to have something adverse happen there at any point in time. Okay.
Bill,
Thank
you very
you.
much. We look forward to hearing again.